Good afternoon and welcome to the Franchise Brands PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged, can be submitted at any time via the Q&A tab situated in the right-hand corner of your screen. Just click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Stephen Hemsley, Executive Chairman.
Good afternoon. My name is Stephen Hemsley. I'm Executive Chairman of Franchise Brands. Welcome to this podcast where we're presenting the interim results for the first half of 2023. I'd like to introduce my colleagues who will be presenting today. Peter Malloy, who's CEO of our B2B division. Jason Sayers, CEO of Filta International. And Alex McNutt, CEO of Pirtek Europe. We've got a lot to get through today, so we will be running through these slides fairly quickly, but I'd like to give you first an overview of Franchise Brands. Our purpose is to build market-leading business primarily via a franchise model. And our philosophy is that if our franchisees grow, we grow. To that end, we have 650 franchisees across 7 brands in 10 countries across UK, Europe, and North America. They operate over 2,200 service vehicles and employ around 5,000 people in the franchise network. We employ 715 people in the support centres and the direct labour businesses. These businesses generate system sales, which is the underlying sales of our franchisees rather than our corporate sales. And on an annualized basis, they're generating 400 million a year. Just like to move on now to talk about the progress in the period. This was a period of significant progress for us with the acquisition of Pirtek Europe, which doubled the size of the group. Pirtek has traded well in the 10 weeks of this year that we've owned it, reaching record levels in most markets and fully meeting our expectations at the time of the acquisition. We've also had strong momentum from Metro Rod and Metro Plumb, which grew system sales by 24% to 35 million. Filta International, the business in the US and continental Europe, also grew system sales very well in the period by 16%. The B2C division, which has had a challenging time since COVID in recruiting and retaining B2C franchisees, most of whom are one man in one van, but it performed in line with our reduced expectations in the current year. So overall, the group generated system sales of 146 million in the first half of this year, up 81%. Statutory revenues were just under 70 million, up 57%, although this is not a KPI of the business because it's made up of a number of different income streams which don't necessarily contribute to EBITDA. EBITDA itself was up 12.1 million or 67% in the first half of the year, driving adjusted profit before tax of 8.6 million, up 45%. Adjusted EPS was up a more modest 4% for reasons I'll come on to talk about later on in the presentation. Because of the board's confidence in the remainder of the year, dividend is up 11% to 1 pence per share. Just now I'd like to talk about the main strategic development in the first half of the year, which was the acquisition of Pirtek Europe, which is the leading provider of on-site hydraulic hose replacement services, operating in 8 countries, mainly through a franchise model. We acquired the business on 21st of April by the acquisition of Pirtek's holding company from a US private equity owner. Total consideration was 200 million plus a cash and working capital adjustment of 10.3 million. This was financed by an equity placing of 114 million, of which 97 million came from a fundraise from institutions and Franchise Brands management, and 17.5 million from the vendors, including the Pirtek management who have joined the Franchise Brands team. We also raised a debt facility of £100 million. The reasons for this acquisition were really around advancing our strategic objective of building an international B2B multi-brand franchisor, which generates its profits equally in North America, UK, and Europe. The reason for that is that we feel that a wider spread of geography and currencies will enhance the diversification and resilience of the business. We're also looking to extend the range of customers that we service to again enhance the resilience of the business. An additional reason was the operational leverage that we can gain from a wider range of businesses from our central services, particularly technology, marketing, and finance. The wider international footprint also gives us the opportunity to expand our existing brands into new markets where we now have an established overhead base. I'd now like to hand over to Peter Malloy, who will talk us through the B2B division.
Good afternoon, everybody. Thank you, Stephen. Just really to give you a flavour of the construct of the B2B division. The division was effectively created in the middle of 2022 to provide a more cohesive management structure. And as you can see from the slide, it consists of 4 businesses. Metro Rod, which is primarily a franchise business delivering drainage and pump services. Metro Plumb, again, a franchise business, and the clue being in the name in terms of a plumbing business. That business is delivered by 15 independent franchisees and 19 combined Metro Rod and Metro Plumb franchisees. You got Willow Pumps, which is a direct labour organisation specialising in pumps, and Filta UK, which again is a combination of direct labour and franchisees operating in the commercial kitchen environment. Just to give you a little bit more of a flavour in terms of the H1 position, as the slide says, continuing strong momentum at both Metro Rod and Metro Plumb. In Metro Rod, system sales increased by 24% on the back of a strong performance also in 2022, resulting in 35.3 million year to date. Job volumes and average order value are 2 key elements of our business, and the jobs in the first half of the year are up over 15% and the average order value up over 6%. And that's really been driven by an increase in the pump and tanker sales, which attract better prices than just the drainage business. And both of these elements grew by over 20% in the first half of the year. To maintain this, we continue to invest in our training and upskilling of our engineers. We now have 72 pump engineers in the Metro Rod network compared to 58 at this time last year. And in the period as well, we've opened our second training centre in Macclesfield to accelerate the training of our engineers on the pump discipline. Very pleased with the franchisees' performance and their growth. 61% are growing more than 20%. And this is on the back of their continued investment. And indeed, over the last month, they've invested a further £750,000 in additional tankers to support the business that we do. Moving to Metro Plumb. Metro Plumb, as I said, is a combined business of independent franchisees and combined Metro Rod and Metro Plumb franchisees. The strategy is to build that out as independent plumbing businesses. And we've got 15 now compared to, I think it was 11 at this point last year. The business has grown at 31%, and this is faster than the drainage growth. And I think it illustrates the size of the opportunity and the requirement for a national plumbing service. A pleasing aspect within Metro Plumb is our reduced dependency on the low-value insurance work that we carried out. And that's had a positive impact on the business by increasing the average order value with a better mix of customers and business, and the average order value increased by 13% year on year. Within Metro Plumb, we have KeyMac, our direct labour specialist plumbing division, and that performed well in the period as well, with an 11% increase on a like-for-like basis in terms of sales. And as the skill set and the geographical coverage improves within Metro Plumb, it enables us to much more aggressively to market the Metro Plumb business, which we plan to do in H2. In terms of Willow Pumps, a pleasing performance in the first half of the year, with sales growing by 10% on the back of significant reorganisation of the management. The management has been restructured, and the founding partner of the business, Ian Lawrence, now takes a much more peripheral role as a non-exec chairman. The change in management, I think, has resulted in a much more focused and determined management team. Under the Willow banner, we have two of our corporate franchisees, and they performed, I think, disappointingly in the period. Although they both made a greater contribution in terms of the management service fee we receive, with their sales growing from 1.1 to 1.2 million. That said, we've decided to sell these businesses and refranchise them. And this allows the franchisees to do what they're good at, and equally the Willow management team to focus on growing the pump business not only in Willow, but in the broader Metro Rod network. Filta UK, a challenging first half of the year, with modest sales growth of about 5%. In part to address this, the sales and marketing director has been changed, and Filta will now sit under the responsibility of the Metro Rod sales and marketing director. I think that will open some doors for us and certainly enhance our cross-sell opportunities. Within the fat soils and grease element of the business, we're transitioning to a franchise model, with now 2/3 of the business delivered by franchisees compared to 1/3 when we acquired the business. And we're continuing to review how we can best optimise the service delivery to expand and grow the attractive parts of the Filta UK business. Running through quickly the financial performance, Metro Rod, the largest part of the division, with over 71% of the adjusted EBITDA. Very pleased with the sales increase at 24%, taking us to 37.3 million at the half year. Margin was impacted by non-recurring events, primarily two. The upside in 2022 of a special project we did with Peel Ports, and then the negative impact of us stepping into an abandoned franchisee in North Scotland this year, which was unforeseen. Admin expenses increased significantly, but for several reasons, mainly salary increases. We believe that by looking after our staff in the cost of living crisis was important, and equally we believe it will pay dividends back to us in the longer term. Equally, Metro Rod have taken on some of the costs and absorbed some of the costs that we've taken out of Filta. All that said, a satisfying increase in the adjusted EBITDA of 13% was achieved. Willow, 11% increase in sales, but a 2% reduction in gross margin. And although on the face of it, that looks like a negative, there are positive aspects. The increase in the amount of work passed to the Metro Rod network, albeit at a lower margin out of Willow, makes a positive contribution to the division. The admin expense increase in Willow was entirely by design. We've increased and recruited, invested in industry-leading staff to develop and expand our range of services, and we're optimistic that that will show benefits in H2. Excuse me. In terms of Filta, revenue grew by 56% on a full-year comparison to 5.6 million, but disappointingly by only 5% on a like-for-like basis. One of our largest business streams, which is the installation of grease removal units, was impacted by the failure of our supplier of the GRUs, and we're optimistic that that will be resolved fairly early in H2. More encouragingly within Filta UK, as a result of streamlining the business and improving some of the operational gearing, EBITDA grew by 23% on a like-for-like basis to 569,000. In summary for B2B, overall growth of 24%, with admin expenses growing by 19%. Admin expenses now a percentage of our system sales reduced from 10.4 to 10.2%. And the formation of the B2B division has enabled us to build a much more cohesive division with greater levels of integration and cross-selling opportunities. So I remain optimistic on the back of a strong first half of the year, optimistic for the second. That's the B2B division, and what I'd like to do is to hand you over to Jason, who will take you through Filta International.
Thanks, Peter. So Filta International is the North American and EU business within Filta. We provide cooking oil filtration and fire management services to commercial kitchens through a network of around 160 franchise owners operating over 500 vehicles. So you see on the top here, it says Filta Max gaining traction. Filta Max is the next phase of Filta's growth. So in the first 10 years of us being in the US, we had the single unit franchise model where a guy bought himself the job. And we built the business there from a startup to about $13 million a year. The second 10 years was the multi-van model, where guys own multi-vans and grew businesses. And our network revenue grew from 13 million a year to 92 million last year. So we're now in the third phase. This is Filta Max. Using the maximum potential model introduced by franchise brands, we've identified 55 key metro markets in the US that can have businesses of scale, basically copying the top 5 franchise owners that we have. Some of them are touching on $10 million revenue, so these are bigger guys. We just had our franchise conference last week, and it was great, energetic, a lot of people there. We have introduced the Filta Max model before, but the whole conference was around Filta Max. And we had one of the sessions, we had the larger franchise owners, 4 of them on stage, and it was great. I was telling how they scaled their businesses. They've got sales directors, sales team, operations directors, operational teams, accounts departments. It's all about, and they're growing fast. It's all about how do you scale the business in the key metros. So in the medium term, Filta Max helps drive system sales to 500 million by scaling the 55 metros to emulate the better franchise owners, on our way to reaching the potential market value of over $1 billion in time. It's all quite exciting. Part of that is the bulk oil supply. So national accounts, we do a lot of national account work in the US, but they obviously buy their oil from elsewhere at the moment because it's a commodity on the market. They're very interested in us for one reason, it's the environmental side. So the bulk oil system we have 5 systems out there right now. It's like the waste oil with 6,000 gallons set up, except we buy 6,000 gallons of new oil at a time. It's filled up into reusable jugs, which are then delivered to customer and reused. So the customers don't have boxes or plastics to put in the bin every time. So there's a real environmental benefit for the national account. That's why they're interested in this. It's green. 5 locations doing this right now, looking to expand that to the 55 key metros in the next 5 years. That's introducing 1 new depot per month doing that. Big benefit for the franchisees, selling at the same price fuel, but buying it in bulk, their margins increase from 18% to 38%. Big win for them. Another service we just rolled over, layered on top, is Filta Clean. Again, national account driven. This is cleaning commercial kitchens. We're only doing about $2 million this year in it, and we launched it at conference. And it's expected to go pretty quickly. One franchise owner who was on the stage actually said last month he has 1 job worth $38,000 cleaning the kitchen. This is something we're looking to layer over and roll out through the franchise network now. And lastly, on Europe, currently is a subscale business, has to grow before it can really contribute to the network. Pirtek acquisition has helped in this regard, and we've been working closely with the German management team there, Pirtek German management team, utilising the resources to see how we can scale the business there. Let's move on a slide. There we go. So waste oil. The selling of waste oil is an important part of Filta's business in the US, albeit it's reducing in overall percentage terms as we diversify. The bars there show the volume in US gallons that we collected over the last 18 months. Volume was up 22% year on year, H1 last year versus H1 this year, hitting record volume. So our volumes are up. To put this into perspective, is the equivalent of over 80 petrol tankers a month full of waste oil we're selling to biodiesel plants. The line there shows the market price, the Jacobson index. And you can see from the chart that the price of waste oil rose in February last year, remained high, and then dipped again in February this year, bringing the price down. Comparing the 2 periods, the pricing's dropped 13%. So the 6 months of 2023 had GP of £1.4 million versus 1 million in the 4 months of last year, despite the record volumes, which grew at 22% year on year. Pleased to say the price has been going up a little bit right now, and the Jacobson forecasting service has it moving up during the remainder of this year. Moving on, one more slide. Here we're comparing the 4 months of 2022 against the full 6 months from this year. System sales increased by 74% to 41 million and 16% on a like-for-like basis. The two biggest points I'd like to make: waste oil sales, despite the record volumes, decreased 7% on last year, completely down to the market price of waste oil. Secondly, royalties and NCA revenue, we consider that the core repeat revenue and lifeblood of Filta going forward, rose 21% top line and 18% at the gross profit level, as extrapolating the 4 months out to full 6 months. This is a key number for us, reflecting the growth of the business. US overhead was up slightly, mainly due to our investment in the sales team, which is currently paying dividends. But admin expenses as a percentage of system sales dropped slightly from 3.9% to 3.7%. Franchise owners continue to invest in new MFUs, that's the machines we have, and equipment to grow their businesses. In Europe, we increased the infrastructure in Europe, but haven't yet seen the growth in the revenue there yet, partially due to the supply chain issues that Peter mentioned earlier. As I mentioned, we're reviewing the models in Europe, and we can now help to integrate it a bit more further with Pirtek in Europe. As a summary, overall, the message is that everything is growing well. Network revenue, Filta's core repeat revenue is up. It really is waste oil market pricing that muddies the message in the short term. But as we continue to grow and add further services like Filta Gold, Filta Clean, we should see accelerated growth in the coming years, particularly once the impact of Filta Max starts to be seen. So that's a summary of Filta International. Just hand you over to Alex to talk about Pirtek.
Thank you, Jason. I'd like to just give everyone a quick overview. Clearly, this is the first meeting we've all had since the integration. Essentially, Pirtek, our core business is on-site hose replacement. We believe we are the largest provider of on-site hose replacement throughout Europe. Indeed, in our top countries, the UK, Germany, Austria, Netherlands, and Belgium, we're number one in these areas. As you can see, we operate some 69 franchise groups. We have 217 centres with 843 mobile units, and over 200 of these centres are actually owned and operated by our franchisees. And since the acquisition on the 21st of April by FB, we have now opened a further 2 centres in Antwerp Harbour and Trier in Germany. The revenues are primarily derived from the UK and Ireland, Germany and the Benelux, where we hold leadership positions with national coverage, allowing us to be highly profitable. Sweden and France are corporately owned, subscale startup markets making marginal contributions, but both with great potential. Our business continues to offer multiple growth opportunities across all countries. And we currently own the perpetual royalty-free master franchise agreement for future expansion into 8 further European countries. It should be noted that over 60 of these 69 franchisees are already on our new royalty model. Thus, when they grow, we grow. And we support this through the use of business plans and growth tools. Essentially, we're emergency response. We operate in multiple industrial sectors: waste management, construction, plant hire, industrial, wind generation, automotive, maritime, forestry, and many more. We target 1 hour response 24/7, 365 days a year. And that's one of our key attributes, and having these centres around the various countries gives us the opportunity to deliver this service. The demand for our service is mostly time critical. Generally, a hose fails whilst the machinery or the system is in operation, making response times more important. our prime task is to reduce the downtime of our clients. We have a diverse portfolio of thousands of customers across multiple sectors, with our largest customer less than 1% of our revenues. The sales consist of national accounts, regional accounts, and local accounts. And in our larger countries, three main areas, we have typically 35% plus. In the UK, our largest single area is 44% of national accounts business. And currently, we're operating 500,000 jobs per year. Our growth opportunities, as well as core, includes THM, Total Hose Management. And on the right-hand side, it gives you a flavour and idea of some of the examples we do. In terms of hose flushing, testing, fluid analysis, and a number of customers will replace and clean out the hydraulic oil, thus being able to use it a second or third time. We offer ram repair, planned maintenance and servicing and replacing of hoses, such as the Bosch automotive plant in Germany. We will replace all hoses over a 5-year period, working with their maintenance department on the shutting down of the robotic plant. We also replace all hoses on Carnival cruise lines over a 5-year period, so they don't have the problem of hoses failing. Some other areas, wind turbines. Wind turbines, we have some major contracts with wind turbine companies, replacing the hydraulics, and some of the length of the hoses from the base to the top of a wind turbine can be in excess of 50 meters long. If we move on to the next slide. Unfortunately, we're not able to give comparators because obviously we've just joined the company on the 21st, but this is Pirtek's 10 weeks into this business. The integration is going extremely well. The chart shows us the figures from each of the main centres. We essentially have 8 countries, but operate them as 5 business units. The UK and Ireland, as I mentioned, is our largest business. 46% of revenues at 17.1 million of system sales and 49% of adjusted EBITDA. The opportunity, even though it's our largest area in the UK, is still incredible, both in core business and on THM. Since the introduction of the royalty system a few years ago, we've taken on board systems expertise to support the franchisees, and that's already proving very beneficial. In Germany and Austria, they now do 36% of our group sales, 13.2 million, with 31% of our adjusted EBITDA. In Germany, in the last 2 months since the acquisition, we've opened up in Trier. Again, another franchisee splitting a centre, opening up another centre close by. The Benelux, 13% of our system sales, 4.8 million, and 20% of adjusted EBITDA. Again, in the last couple of months, we've opened up Antwerp Harbour from one of our Belgian franchisees. In Sweden, the growth will come from rolling out additional MSUs, mobile service units. And in the last 12 months, summer last year, we've opened up the Gothenburg Centre, and that will continue and give us a platform potentially in other Scandinavian countries. In France, we've got into France in the last year or two. Our presence is mainly in the Ile-de-France area, which is the Paris region, and Lyon and Grenoble. And in the beginning of May this year, we've opened up in the Collegian area. Again, we will continue to grow in France by putting in additional MSUs, and it's still early stages, but we believe there's a tremendous opportunity to continue the growth. The 3.8 million delivered over the 10 weeks has resulted in a number of countries having record sales in these last 2 months, record sales and record EBITDA. And our business going forward, from our point of view, we're very comfortable and confident in terms of our budgets. And our expectations were reached in these last 10 weeks. So we're very confident going forward for the future. I'll also say that the integration process, working with franchise brands, finance, marketing, and IT departments, we also believe will lead to further success. Each of these senior heads of departments have been in all of the Pirtek centres, on all of the Pirtek head offices over the last few months, and we believe we've got much more to come from this, but it's still early days yet. So overall, it's a case of sharing best practice within the organisations, and we believe we've got a very bright future. So I'd like to pass over to Stephen now to discuss the B2C.
Thanks, Alex. B2C, let me just move on the slide. B2C, as I mentioned earlier, faces a number of challenges in the franchise recruitment market at the moment. After the COVID period, a lot of people retired early, work-life balance became an issue. So the number of franchisees we had in the system reduced. At the same time, though, quite a few people decided they wanted to go self-employed rather than carry on employment. So our recruitment levels remain reasonably buoyant. First 6 months of this year, it's changed somewhat. In the first 6 months of this year, we've had high employment, high wages, elevated inflation, people, I think, becoming more risk averse. Banks are being more cautious in lending to new franchisees. So in general, self-employment has become less attractive. That's been a bit of a challenge for the recruitment side of the B2C business. However, retention has improved because this risk-averse nature has meant that people actually are sticking with what they've got and haven't left in the volumes they did post-COVID. So the recurring income from the franchise community has been maintained quite well. We're pretty pleased with the 24 franchisees we've recruited in the first half compared with 30 in the more buoyant period last year. As I said earlier, this has led to a reduction in profit, headline rate by 23%, but last year we also sold the domain name of My Home for 100,000. So if you eliminate that sort of one-off income, underlying it's down 17%. Now, earlier in the year, we announced that we were undertaking a strategic review of B2C and subsequently put it up for sale. We've received some offers for the business, but none that we consider satisfactory. So we've taken decisions to stop marketing this business and as a result, reincorporated the results of the division within the group. Just looking now more generally at the overall group results. As I mentioned before, system sales is the sales of the underlying franchisees, and following the acquisition of Pirtek, this has grown by 81%. Now, system sales is a key KPI of the business because this is what drives our MSF or royalty income and the margin on our direct labour businesses. So we're pretty pleased with that result. Admin expenses up 80% in the period, just a little bit shy of what system sales were up by. But the main reason for that very high level of growth was the acquisition of Pirtek, which added about 5 million of additional overheads, and the annualisation of the Filta deal that we did last year, whereas in the first 6 months of last year, they were included for only 4 months, whereas in this period for a full 6 months. So the underlying increase in overheads across the group was 1.3 million or 13%. And the main drivers of that were salary costs with the inflationary rises needed to retain and recruit the people we need, and also professional costs, particularly audit costs, which I think were up 100 and something odd percent. Adjusted EBITDA, which is the key KPI of the business, increased by 67% to a record 12.1 million, driven by the Pirtek acquisition, the Filta acquisition annualising, and the strong contribution from Metro and Metro Plumb, slightly offset by the reduction at B2C. Depreciation, amortization of software and finance charges all rose in line with the acquisition of Filta and the acquisition of Pirtek and the annualization of the Filta numbers. The tax charge in the year increased from 20 to 24%. And part of that related to the increase in the UK tax rate from 19% to 25%, but also the broadening international aspects of the business where a lot of the overseas tax rates are higher than they are in the UK. And I'll talk about the impact that had on EPS in a later slide. Below the adjusted profit line, amortization of intangibles, share-based payments, all impacted by the acquisition of Pirtek. The non-recurring costs were the acquisition costs of Pirtek in the current year and of Filta in the prior year. As a result of taking all this expense within the first half of the year and only 10 weeks contribution from Pirtek, we actually incurred a statutory loss during the period, but that'll be ironed out by the time we get to the year end and we have a full 6 months contribution from Pirtek. Adjusted EPS and dividend. The EPS for the year increased by a relatively modest 4%. And the reasons for that were the shares issued for the acquisition of Pirtek, raising £114 million. And coming back to this tax rate, the tax rate increased by 4%. And if you eliminated that and charged a consistent rate of tax, EPS would have grown by a more respectable 10%. EPS was also reduced by the reduction in profits at B2C and to some extent by the fact that the oil price movement that Jason mentioned earlier on. Notwithstanding that, the board is confident with the outlook for the year and reconfirms the 29 million forecast that we put out at the time of the Pirtek acquisition, and as a result has increased the dividend by 11% to 1 pence per share. Cash flow and leverage. Now, I've tried to simplify what is, in the 6 months, a very complicated cash flow statement in the RNS. So what I've done here is try to analyse out the cost of the Pirtek acquisition, how we funded it. So the Pirtek acquisition, 200 million, acquisition costs just over 6 million, funded by the share issue of 114, raising the term loan of 100, and the net cash flow from operations, which looks like a fairly modest number, but there were lots and lots of different things happening within that number in the year. But that combined generated cash in the period of 10 million, which together with the 10.8 million we had at the last year end, meant that we finished the half year with net cash of 20.8 million. Now, if you set that against the term loan and the RCF, and a little bit of higher purchase debt, we ended up with adjusted net debt of 79 million. Now, that's not our total debt, because to that you need to add the 7.2 FRS 16 right to use assets debt number. So in total, we had about 86 million. But the reason I focus on the 79 million is that's the number the banks use to test our covenants. So just going over to the right-hand side of this slide, the covenants are tested against the last 12 months results. So in the last 12 months to 30th of June, assuming we owned all the businesses for the whole period, the group achieved profits of 31.9 million. And the forecast to the end of the year is for LTM to be 33.5 million. Now, if you applied that against the 79.1 million of adjusted debt, you end up with a debt multiple of 2.48 times at June against a bank covenant limit of 3.4 times, so very comfortably within that. And we're forecasting 2.36 times at the end of the year, which again is comfortably within both bank covenants and what we forecast at the time of acquisition. I think it's fair to say we're very pleased with the rate at which the company has de-geared in the very short period since the acquisition, and look forward to that continuing. Just a few words on corporate governance. We've had, as the business has grown, quite a large board. And every time we've made an acquisition, the CEO of that business has tended to join the main board. We've got to the stage now where the size of the board and our corporate governance profile needs to be addressed. So we are going for a two-tier governance system. We're going to significantly reduce the size of the PLC board to just myself and our newly appointed CFO and 3 independent non-exec directors, plus Nigel Ray, my founding partner. The CEOs and the leaders of all the central services will then join a management board, and that board will meet at least quarterly in the various locations we have around the world now. So all the CEOs and the central service leaders can see how the business actually operates on the ground. Pleased to announce today the appointment of Mark Fryer as our new CFO. He joins us next Tuesday. Very experienced guy, been through AIM companies, fully listed companies, right up to FTSE 250 companies. So we're looking forward to the experience that Mark will bring to the group. We're aiming to get all these changes done by the year end, and we'll make announcements in due course. Corporate development and capital allocation. Having geared up to quite some extent to undertake the Pirtek acquisition, our priority now is repaying that acquisition debt and reducing the gearing. Our capital allocation policy will, however, still balance debt reduction with a progressive dividend policy and the needs for organic investment to expand business, but we won't be looking to make significant acquisitions. We expect our leverage profile to fall to a debt to EBITDA multiple of 1.6 by the end of next year, and fully expect the whole of the acquisition facilities to be repaid within 5 years, although we probably won't do that because I think it will be sensible for maximum efficiency to retain some gearing on the balance sheet. But our target leverage is 1 to 1.5 times adjusted EBITDA before we will consider another acquisition of scale. So in summary, another very productive and successful period for the group, building a business of international scale and generating our profits on a worldwide basis. We also see great opportunities to grow the Metro Rod and Metro Plumb business, which still have very small shares of a very large market in the UK. Huge potential for Filta in North America, given the unique nature of its business and the absence of any real competition. Pirtek has a lot of exciting opportunities in growing their existing mature markets with new product ranges, scaling up their early stage markets in France and Sweden, and then longer term, as debt reduces, expanding the business into the new markets, because as Alex said, we have the right to use the Pirtek brand in a further 8 European markets. We once again have confirmed our forecast for the full year of 29 million of adjusted EBITDA, at least 29 million of adjusted EBITDA. So thank you very much for listening to the presentation. I think I now go to questions.
Absolutely. Stephen, thank you very much indeed. And thank you and the team for your presentation today. Ladies and gentlemen, do continue to please submit your questions using the Q&A tab, just situated on the right-hand corner of your screen. But just while the team take a few moments to review those questions submitted already, I'd like to remind you the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Stephen, as you can see, we've had a number of questions come through from investors throughout today's presentation. If I may just ask you just to click on that Q&A tab, start at the top, just read out the question where appropriate to do so, or pass it to one of the members of the team, and I'll pick up from you at the end.
Oh, I'll definitely be passing to the members of the team, especially this first one, which I think Peter has probably answered, which is, has the disruption in the supply of GRUs impacted the Filta UK ops. Has it been resolved? And what do you think the timescale of that is?
Do you want me to take that, Stephen?
Yes, please.
I think it's fair to say it isn't fully resolved. It is almost resolved, and we certainly anticipate it being brought to an end within probably the next 4 to 6 weeks. I think it's also fair to say clearly it had a disruption on the first half of the business, but out of every problem comes an opportunity. What it's enabled us to do is to re-establish some other broader supply chains to deliver a wider range of solutions to our customers. So we will ideally be in a place where we maintain the GRU that we've been working with. As I say, we can provide alternative solutions. And importantly, in the first half of the year, we fulfilled all of our obligations. All of our customers got what they needed to do. I guess the impact was the slowing down of our sales development to promote the product where we had doubts over the supply chain. In terms of the financial impact, circa £200,000 in terms of any direct impact on the sales in the first half of the year.
Thanks, Peter. Next question is, what are the key benefits you see of your scale now? Do you have a central operating system, and how is your digital transformation impacting the business overall? I'll take that one. We don't have a central operating system as such, but we do have our vision system, our works management system that we use in our UK B2B businesses. Now, what we're now doing is looking at whether that is applicable to the business of Pirtek. We're currently undertaking a gap analysis. The team at Pirtek are looking at a vision to see if it works for them, but we're reasonably optimistic it will have applications in the Pirtek business. Filta in the US has its own operating system, which works very well for them, recently been updated. So I think in terms of one central system, no, because all the businesses are different and they have different requirements. How is the digital transformation coming on? That is an area where we do share expertise. There are a lot of projects going on at the moment using AI. There are a lot of things being learned in different markets, in different applications around the group that we think we can apply more generally. Long term, we think one of the keys to generating operational leverage within a franchise business is the use of technology. And we are currently in the process of doing a sort of a blue skies thinking project of what it could look like in 5 years' time, what we would need to do and what the roadmap will be to get there. And we may well be talking about that by the end of the year. So I hope that answers your question, Mark. Questions from Damien. What reasons did other parties give for making unacceptable offers for the B2C business? I think all the reasons that the business is underperforming at the moment, the difficulty with recruitment, the attrition of the franchise system, high interest rates, uncertainty out there in the consumer market. Some of the people that did bid at modest multiples of profit. This is a business that makes £2.2 million a year. It's highly cash generative. So it is an attractive business. I just think that the market background at the moment is not conducive to pursuing a sale. So what we've said is that we're no longer going to market it. Hope that answers that. Damon's got another one here. Is the Filta business in Europe really viable given the lower density of frying type restaurants? I'll start with that one and then hand over to Peter. The franchise model in the UK and in Europe based on just filtering frying oil is not compelling. And one of the things we're doing in the UK is extending the range of services that the franchisees offer into such things as servicing GRUs. I think we'll probably be doing the same in Europe. Alex and his team in Germany are also looking at that business at the moment to see what opportunities there are. Do you want to expand on that, Peter?
I think you're right, and I'll come to Jason in a moment, because Jason, I think, has got more knowledge than either of us in terms of the European setup. But essentially, you're right in terms of the breadth of services to make it a viable franchise. And, you know, I accept the argument in terms of the fryers, and Jason may counteract that argument, but the installation, servicing of GRUs and the regulatory pressures to stop people polluting the drains certainly present an opportunity in Europe for us on that side of the business. Jason, do you want to add anything on the fry side?
Yeah, and it differs. It's a great question, actually, because it also differs country to country. So you look at Germany. Germany's somewhere between the UK and the US in terms of market, whereas there's loads of fryers per site in the States. So people have heard me before say even the hospitals we serve have 8 fryers in them, so it's ridiculous over there. In the UK has, you know, it's a lot healthier, less fryers per site. Germany in particular has less places that fry, but those that do fry have quite a lot of fryers sometimes, brew houses, that type of thing. So there is a market there. But to really fully expand, you're absolutely right. We're looking at adding the other products and services to that to make it a more compelling franchise.
Thank you, Jason. Right, third one up for Damien here. Why do corporate franchisees seem to perform more poorly than independent franchisees? Well, that's very easy. We're not very good at running them, and that's similar in most franchise businesses.
I think the other bit, Stephen, is the skin in the game element.
Yes.
You know, the franchisees have invested in the business. They've got a vested interest to make that succeed. Now, I'm not saying our management's poor and not committed, but there is a completely different mindset in a franchise business than a DLO. And you're right. You know, we are franchise experts. We're not necessarily experts in DLO businesses.
Now, Pirtek, Alex's team at Pirtek are putting a different spin on that, because they are proving quite successful in running some of the corporate franchises. So what's your secret sauce, Alex?
Yeah, well, listen, I think what Peter said is probably, in terms of the local franchisee having skin in the game, is very, very important. So you've got a local person, an owner there. He puts in more than his tuppence worth. However, when one looks at the centres that are given back through mismanagement or a franchisee going bust, you're usually picking up, the corporate are usually picking up a problem centre. It could be a problem with staff, problem with customers, poor service, and so on. The reality, it needs some TLC, tender loving care. Now, we've been fortunate. We have had some issues historically, Pirtek, but the last 4 that we've taken back, we've actually turned them around and sold them for more than what we picked them up for, actually. And the reality is we have a model in terms of putting things in right, and what we wouldn't do is ask a franchisee to do something that we wouldn't do. So I do agree with Peter. Having a good franchisee who's got skin in the game is always great. But if you've got a problem franchisee running a problem area and you do take it over, you need to go in and clear out, make sure that the processes are working like the best franchisee out there. And as I say, Stephen's right. We've got now some history behind us of a number of franchisees that have, the areas have been turned around, and we've actually sold them on for substantially more than what we've taken them on for. So it's all about, depends what you take on.
Well, we'll be trying to learn from you, Alex, that's for sure. Thank you. George has got a question here. What is the plan now with the B2C business? To carry on running it. Tim does a great job running it day to day. The market will recover. What we're seeing at the moment is temporary. And the other somewhat exciting thing is that Alex has had a look at these businesses and has introduced them to his team in Europe. And there is some interest. Alex, would you like to?
Yes, I mean, we've had dialogue with Tim, who runs the B2C on Chips Away, and it's an area we think there may be some possibility in Germany. As such, we have a meeting lined up the end of next month, with the German management team coming both to see Peter regarding Filta and what they've done in the UK, and also to meet with Tim and myself till we see if we feel there's an opportunity. We certainly have got a number of franchisees in Germany. We've got 92 centres, and some of them have expressed some interest in it. So it's too early for any green shoots, but we would like to look at it a bit deeper, actually. So the fact that it's not been not for sale at this moment in time, or it's not up for sale at this moment in time, we're quite happy with that. It will give us a chance to see, because if we believe there's an opportunity for some of our bigger franchisees who we don't want to grow within our current network to have another business, then we'd be comfortable with that as well, actually.
Thank you. Hope that answers the question. And at the moment, I have no more questions.
No, just a thank you from Damien. So thank you very much indeed, Damien. And thank you from everyone for submitting your questions. Of course, any further questions that do come through, the team will be able to review those, and we'll be able to publish those back out to you where appropriate to do so on the Investor Meet Company platform. Perhaps just before redirecting the attendees to give you their feedback, Stephen, if I could just ask you just for a few closing comments, please.
Well, firstly, thank you very much, everyone, for attending and listening to us. I hope we've managed to give you a good idea of what Franchise Brands is all about. We're a very rapidly growing company in diversified markets with international diversity now. So we're very resilient. Franchising is a great business. It generates a huge amount of cash, and we support our franchisees in growing their business. As I said at the top, if our franchisees grow, we grow. And that's something we do know how to do. We may not be great at running corporate franchises, but we know how to grow franchise systems, and we collectively have a lot of experience in that industry. So I commend the story to you. Thank you for listening. Have a good afternoon.
That's fantastic, Stephen. Thank you very much indeed. And thank you to Alex, Jason and Peter as well for updating investors today. Can I please ask investors not to close this session? You should now automatically be redirected to provide your feedback in order the team can better understand your views and expectations. This will only take a moment to complete. It's greatly valued by the company. On behalf of the management team of Franchise Brands PLC, we'd like to thank you for attending today's presentation. That concludes today's session, and good afternoon to you all.
Thank you.
Thank you. Goodbye, everyone.